Okay, so this is a recording to go through the results of the ARR tasks. If you haven't looked at the actual explanation of ARR and the investment analysis tool, then I suggest you watch the previous video before that. That's going to make more sense. So in the previous video, I explained how you completed question 1 of the ARR. So that's the one we got up here. I'm going to go through and explain the results for question 2, 3, 4, and 5. So let's have a look. Question 2. A business is considering an investment of £140,000. The business estimate that total cash inflows over 5 years will be 600,000 and the total cash outflows will be 400,000 over the 5-year period. Calculate ARR. So the important bit to sort of think to yourself here is, first of all, what's the initial investment? And so that's what we got, what I've listed over here for task 2. So the initial investment is £140,000. Next thing is we need to work out what's the net cash flow over that period. And the tricky bit here is that you really need to read this question well, because actually it says over the lifespan of the entire project over the 5 years, they will have inflows of 600,000 and outflows of 400,000. So not per period or per month, but over the entire life. So what is the net cash flow? Well, that's simply, and that's what I've done, the calculation I've done in here, is simply by saying total inflow is 600,000, total outflows is 400,000, and that gives us 200,000 net cash flow. So we've got 200,000 net cash flow. We have got initial investment of 140,000. So that flows out of the business. So the total return is going to be all of the net cash flow we have made. So all of the money we have made minus the initial investment. And so that will give us £60,000 total return on doing this. So it actually makes sense in that sense to make the project, because it basically says we're going to make £60,000 if we do this project. What we then want to try and work out is, you also sometimes refer to this as the average return on the project. So actually we want to work out on average how much is the return per year. And so what we could say, and so that's what I'm going to calculate down here. So what we could say is, well, its total return is 600,000. So that I'm calculating it in this thing in here. And we're saying the total return is 60,000 divided by 5, and that gives us £12,000. And then to do the accounting rate of return, this last one, what I've said is simply £12,000, so that's the return per year. That's how much we earn per year, divided by the initial investment times it by 100 to get a percentage, and that gives us 8.57%. Now, is that good or bad? Well, it's impossible to say unless you compare this to some other investment you got, and whatever get the highest return would be the best investment. But what it does tell us is that because our return is positive, is that we will make a rate of return of 8.75% per year. And you could kind of compare that to the return on capital employed in the when you just do it for an entire business. And you could see this particular project, if that has got a higher return, this particular project, than what the return on capital employed is in the business in general, what this suggests is that it would be a good idea to invest in this particular project, because actually it's the kind of project that will help have a positive influence on the return that the business would generate overall. but that might be a little bit too far. What we are focusing on here is you should really be able to compare it project compared to another project, and then work out which has got the best. Now let's try out question 3 over here. So question 3, a large chain of DIY stores is looking to expand into a new town. The business has been presented with 2 possible sites for a new store, site A and site B. And so I've laid out site A here, and we got site B down here. Site A has got an initial investment of 140k. So I put that down here, 140k there, and an estimated cash outflow of £100,000 per year for 5 years. So cash outflow of £100,000 over 5 years. So I've done this in here, cash outflow, and I simply just said £100,000 times by the number of years down here, which is 5. So that should give us 500,000 cash paid out across the life of this particular project. It also says here, so the next line reads, the DIY chain estimates the cash inflows will be £425,000 each year for 5 years. Okay, so again, what I've said is cash inflows would then be £425,000 times by 5 years. So that's this one. I get down here again, times by 5 years, because it's 425 per year over 5 years. So, and that gives us 2.125 mil. So what's the total return? Well, I've calculated it down here. I've simply said cash inflow minus the outflows minus the initial investment, and that will give us our total return, which turns out to be 225,000. Again, we can see by just doing that we're going to get a positive return on the business. So that's a good thing. But with this ratio here, we want to know on average, what do we get per year? What is it per year? And so we can calculate that down here simply by saying total return per year divided by, you can't really see it here, but divided by that 5 over 5 years. So 225,000 divided by 5. And that gives us a return per year of £45,000. So again, that looks pretty good. What does that mean in percentage terms? Well, we can calculate that by saying the return per year, which is £45,000, divided by the initial investment and times by 100 to turn it into a percentage. And so that will give us 3.21%. Is that any good? Well, can't really say that until we have looked at site B and how much return site B will give us. So with site B, let's go over and read the write-up for site B. Site B has got an initial investment cost of £2 million. So let's just put £2 million in here under site B. The cash outflow is £40,000 per year for 5 years. £40,000 per year over 5 years. So if we put that in here, so we're saying £40,000 times by 5 years, and that gives us £200,000. In terms of income, it says the cash inflow is going to be a quarter higher than the yearly estimated inflows of site A. So it's going to be a quarter higher than the yearly estimated inflows for site A. So what I've done there is I've said, first of all, what's the yearly estimated inflows for site A? Well, we saw up here that the yearly estimated inflows was 425,000. So it's going to be a quarter higher, which is the same as saying 25% higher. So a little cheat trick, which I've done up here, is if you want to increase a number, in this case £425,000 by 25%, all you kind of have to do is what I've done up here, times it by 1.25, or in other words, 125%. And that will increase the value of the 42,500 by 25%. If that's a bit step too funky, what you could also just say is 425 100,000 times 25% divided by 100, and whatever you get there, whatever the result of that is, you would then add to the 425%. So that's maybe a more conventional way of doing it. But of course with that, that's only for 1 year. We also want to times it by 5 years. And so that's effectively what I'm doing here. I'm timesing all of that by, so 5, effectively that's what it says up here, 5 years times 1.25 times 425,000. And that will give me this result here, 2.656 mil. So what's the return? Well, take the inflows minus the outflows minus the initial investment, and that will give me the total return of 456,250. That you can see that's what I'm doing up here. So the blue minus the purple and red. Again, a positive return on that. So let's divide it by, so what's the return per year? So I'm just saying the 456,250 divided by 5 years, and we get 91,250. And the accounting rate of return is then going to be a return per year, blue, divided by the initial investment, red, times by 100 to turn it into a percentage, and the return is 4.56. So which option is best? Well, let's compare. So option A gave us 3.21% return. Option B gave us 4.56, so that's higher than option A. So therefore option B is best. So let's go with option B. What is noticeable though is that the return per year of side B is 91,000-ish. The return per year for option A is 45. So on paper it sounds like, oh, it's option B is so much better. But actually the initial investment of option B is also significantly higher than it is for option A, and therefore when you see it on a ratio basis or percentage basis, the two options, option A and option B, although option B is better clearly, it's not that much in percentage terms, and that is because the initial outlay is fairly higher for option B, but option B is still the best. Task 4. So I decided, because they showed it with inflows and outflows, to sort of lay it out slightly different than what I've done in the other options, a bit sort of similar-ish to what we did with the payback period, and I suppose also to some extent with the NPV. So what does it say here for question 4? So for question 4, what's happening? Something with a tanning salon, there's going to be an initial cost of 100k. So I'll put that sort of in here, 100k. And then we can see the estimated inflows and outflows. That's what we got here. So I've just literally put the cash inflow I've sort of hidden that here, have I? So you can see the cash inflows here and the cash outflows. That's literally just the figures that I put here, and I sort of put them in here, in this box here. And using those, I've calculated the net cash flows, what we would have net across the period. So the first year 0 gives us a net cash flow of minus £100,000, because that's what we're paying out of our bank account. The next year, year 1, well, we got 120 being paid in, but we got 220 being paid out. So that gives us another minus £100,000 net cash flow. So that's not great. Next year, 150 minus 170 is minus 20, and so on. So it's actually not until year 3 that they start to make a positive net cash flow. That's not even a positive bank balance, just a positive net cash flow. But anyway, just sort of continue doing that through calculating this column here. And once that's calculated, you can calculate the total return. And that is simply done. This is not the bank balance we're trying to work out. It's just across the years, what's the total return. And it's simply just done by, in here, by adding up every single number in this row. Just sum the whole thing, add them all up. And once that's done, so we've got minus 100,000 plus minus 100,000 plus minus 20,000 pounds. Now we're going to have minus 220,000, but then we go plus 50, so that's going to be minus 170, plus 110, so that's going to be minus 160, and then plus 140, that's going to give us a positive return of 80,000 pounds. So that's cool. Now, so that's a slightly different layout to what we've done above, but now it should be sort of fairly normal in that this is happening across, we can see 5 years. 5 is the last year. So we then say the return per year is going to be 80,000 pounds divided by 5. And that gives us a return per year of 60,000 pounds. And the accounting rate of return is simply like before. We say the rate of return is 100 or 16,000 pounds divided by the initial investment of 100,000 pounds. Notice I don't say minus 100, but I just say 100,000 times by 100, and that gives us a percentage of 16. Again, is that good or bad? Well, you can't really say that unless you've got another project to compare that to. And then the last one, question 5 here. So with question 5, question 5 is a little bit funky because it's months and not days that we do this in. So, years. So, ice cream seller has 2 options to expand his business in the summer season, June to September. Option 1 is to rent an ice cream van for an initial investment of 4,000 pounds. So that's what I put in here. So this is option 1 up here, and I put in 4,000 pounds. He believes that it will result in a net cash flow of 150,000 pounds in June. And so that's what I put in here. So I've listed it down here: June, July, August, September. So I put in 115,000. And then it's going to increase by 20% per month, each month until September. So every new month is going to go up by 20%. So this next month, I've just done one of those slightly cheeky little increases of in this case 20% by saying 1,500 times by 1.2, which is also 120%. And that's how you increase by 20%. If I wanted to increase by 30%, I could have gone 1.3. If I wanted to increase by 40%, I could have gone 1.4, and so on. But that's what I'm doing. Next month as well, it goes up by 20%, and the next month it also goes up by 20%. And so we end up with a total return of, if you just add them all up, of 4,052. Then we're not talking about months here, we're talking about periods. So the return per month here is going to be, the total return is 4,052 divided by 4 months, and that gives us a return per month of 1,013 pounds per month. And the accounting rate of return is then 1,013 divided by the initial investment of 4,000 pounds and times by 100 to make it a percentage, and that gives us 25% return. Is that any good? Well, let's look at option 5. So in option 5, it actually says option 2 is renting a beach shack will increase the summer season to October. So now we actually got more months: June, July, August, September, October. The cost of renting is 6,000 pounds. So that's what I put in here. The seller believes they will lead to a net cash flow of 2,500 per month. So that's what I put in here. Except in October, when the net cash flow is expected to fall by 1.5%. So I've done this calculation up here, and so what I've said is, if we look up here, I've said it's 2,500. It needs to decrease by 1/5. So I've times it by 1/5, and I'm then subtracting that whole thing from 2,500, and that will give me 2,000 pounds. So in terms of the return on this, I'm just adding everything up again, this whole sort of row here. And so adding all of these numbers up, minus 6,000 pounds cash outflow in the beginning, plus 2,500, plus 2,500, and so on. It gives me a total return of £6,000. Number of months is 5, so the return per month is going to be £6,000 total return divided by 5, and that gives me a return per month of 1,200. And we can then sort of work out the accounting rate of return by saying the return per month is 1,200 divided by £6,000, which is the initial investment, times by 100 to give it a percentage. And that gives us a rate of return of 20%. So what option is the best? Well, option A gives us return of 25%. Option B gives us return of 20%. So option 1 is best. Again, notice that the return per month there's not that big of a difference. In option A, it's £1,000 in option B is 1,200. So it's not a massive difference. But again, because the initial investment is £2,000 more for option B, so that's £6,000 compared to option A, which is £4,000, significantly more there. That is what really brings down this overall project, and as a result, option A is the best option, mainly because the initial investment is significantly cheaper. So in this case, go with option A.